of a recession.
What in the world is happening on Wall Street?
It's a time bomb.
We're down by between 3 and 4.5%.
A recession occurs when the economy experiences a significant decline in economic activity. While the classic definition often refers to 2 consecutive quarters of negative economic growth, it's important to note that various factors contribute to identifying a recession. In the United States, the National Bureau of Economic Research, NBER, takes a broader approach, considering multiple indicators such as production, employment, and real income. This nuanced perspective allows for a more comprehensive understanding of economic downturns beyond simple GDP figures. Besides a prolonged decline in gross domestic product, GDP, one of the most obvious measures of a recession is the unemployment rate. When this begins to rise, it can trigger a domino effect of economic consequences as demand for goods and services slows down. During the last global recession, unemployment hit 9.5% in the US, according to the Bureau of Labor Statistics. Although employment is high in many major economies, sentiment, another key indicator, remains low on the Consumer Confidence Index despite having improved in 2023. This is due to factors such as the cost of living crisis leading to less spending, which can cause the economy to contract and tax revenues to decline. Global growth has shown resilience in 2023, and inflation rates are falling faster than expected. But world trade growth, a predicted 3.3% in 2024, is still well below its historical average of 4.9%, according to the International Monetary Fund, IMF. In fact, the IMF expects growth to decline in advanced economies this year before rising again in 2025. Stable growth is expected in emerging and developing economies during 2024-5, but with regional variations. Stock markets are also likely to struggle during recessions. As consumer confidence and spending decreases, companies may be forced to lay off workers, which can lead to poor investment performance and panic in the market. In the 12 recessions following World War II, the US index of stocks, the S&P 500, contracted by a median of 24%, according to Goldman Sachs. Unemployment could rise. Graduates and school leavers may then find it more difficult to find jobs. Companies may struggle to pay their workforce or give their employees pay increases to match inflation, according to the Institute for Fiscal Studies. During a recession, we may see an increase in foreclosures, and banks will be less likely to loan money to potential borrowers looking for a mortgage or a personal loan, according to Forbes. Central banks can lower short-term interest rates. This can increase consumer confidence and stimulate spending, as the cost of borrowing is lower, meaning the cost of buying items such as cars and homes is also less. To keep unemployment at bay, governments can introduce policies such as tax cuts to help consumers or launch infrastructure programs, including construction of roads and railways. Recessions end when growth resumes again, no matter how slowly this happens. During the Great Recession of 2008, for example, governments introduced a number of quantitative easing measures, pumping trillions into the global economy in an attempt to resuscitate it. Following this unprecedented level of stimulus, markets began to recover, although lingering scars like higher unemployment and lower average income levels remained many years later. Elevated geopolitical risks mean prices will likely remain high for key commodities, including oil and gas, rating agency Fitch predicts. The World Economic Forum's latest chief economist's outlook finds a mixed picture for the coming year, with just over half of the chief economists surveyed 56% expecting the global economy to weaken and 43% foreseeing unchanged or stronger conditions. However, there is more uncertainty on the horizon, as it's also a major election year for the US, the world's largest economy, and around the globe, as the Forum highlights in its Global Risks Report 2024. Despite the challenges posed by recessions, history has shown that economies can recover with time and concerted effort. While uncertainties may persist, proactive measures and international cooperation offer hope for a brighter future. By fostering innovation, investing in education, and promoting sustainable growth, societies can build resilience against future economic downturns,